Well, good morning. This is Rich, and welcome to this month's aftermath. We're going to talk about markets and quite a bit more here. So, thanks for joining. And without further ado, let's go ahead and dig in. So, what do we got going on this month? Well, certainly South America continues to be the biggest focus of the market. We're watching their crop numbers. USDA put out its estimates on Friday for the South American crops. Tomorrow morning, CONAB will put out its government numbers for the month of February in Brazil. So that report will be out early tomorrow morning. So certainly we'll be looking to see how much they reduce the crop. I think everybody assumes that crop's going to get a little smaller. The question is how much. U.S. grain stocks have grown the last couple of USDA reports. We'll look at those numbers here in a few minutes. China continues to struggle in its bounce back from COVID. So we'll look at that impact. The Black Sea trade continues to be a factor for the market. And really, it's been a kind of a negative factor, I guess, because you've seen the corridor really open up now, and Ukraine has been able to ship quite a bit. And then lastly, the hedge funds. We continue to focus on what they've been doing, and they've got a huge short position now in corn, soybeans, and wheat as well. But when you look at the impact of the funds in the commodity sector, especially over the last 4 years, it's really pretty evident looking at the Goldman Sachs index, where the commodity markets really rallied sharply in late 2020 through 21 into 22. Most of that driven by fund buying. Since then, you've seen the funds turn sellers in the commodity sector as they've taken their cash to other places, like the stock market, like interest rate markets. And so that's really been evident by this index. And I've showed this the last couple of months, and I think Peak Trading does a nice job of putting this chart together, really showing just the hedge fund impact in the ag markets. And this chart shows their net position in the corn and the wheats, soybeans, bean oil, bean meal, the meat markets, cotton, sugar, coffee, and cocoa combined. And the black line is their net position in these ag markets. And, again, go back to February of 2022 when the hedge funds were long over 800,000 contracts in ag. And now, as of this last week, they're down to short 557,000 contracts. And this includes, some of these markets that they're long right now. They're long cocoa. They're long the meat markets as well. So this is the net of all of their ag markets as of last week. And so certainly you can understand why commodities have been dropping. Now, before I dig into the ag markets, I want to talk about the Masters of the Air. I've been watching this show. Many people probably have, but we've got a lot of high markets right now, a lot of high charts. Let's just say that. U.S. debt cleared the $34 trillion number this past week. So that one's the one I guess I'm leading off with this month, because it seems to be the one that continues to climb the fastest. Olive oil, I showed this last fall, but olive oil futures continue to trade to new high, or maybe it's not a futures market. I guess it's a global price, but it's traded in Spain, I believe. The cocoa market continues to make a new high, trading to a record high as well this year. The gold market has traded to record highs, cleared $2,200 an ounce last week, still trading this morning at $2,185 an ounce. So that market continues to be hot. And typically that's a flight to safety market. So I'm not real sure what's been driving the gold market so much, because you're seeing other markets trade high as well. Bitcoin this morning trading to a new all-time high at $72,000. That, I think, it was a new high on Friday and a new high again here this morning. NVIDIA, that's been the hot stock, the chip maker. That's traded to a new all-time high as well, and it continues to pull the S&P. If you look at the S&P index, trading to an all-time high at the end of last week. I believe we hit 5,200, if I'm not mistaken, last week at the end of the week. So we're seeing a lot of interest, it looks like, in these hedge funds rolling money into the stock market, certainly. The cattle market, I think I showed this picture maybe last month, but Fox News it even hit the news cycle talking about how cattle numbers are at the lowest they've been since 1951. Cattle has rallied sharply off of its winter low. And back in the winter, we were trying to figure out why the cattle market had traded lower, and there really wasn't a great reason for it. And so fundamentals hadn't really changed, and now you've seen cattle trade $20+ back up off that low. Now, again, I do want to point out the indicators at the bottom of the chart, because these are some things that I write about a lot and talk about a lot. It's our heat check column in my market report every night. We really focus on the RSI and the stochastics, but we had reached well into overbought status here when this market had gotten to about 185, but it really hasn't been able to break either. And so we've hung in there pretty well, even though it even made a new high this morning early prior to the market settling back down again. So the 9 and the 20-day moving average sitting pretty flat right now, seem to be trying to hold this market. We'll see if it can, but the indicators at least have moved back to kind of neutral territory. So, if we can hold the market right now, that seems to be a win. For feeders, kind of the same way, although feeders did break below the 9 and the 20-day this morning, indicator lines have actually turned a little bit lower. And so I continue to push that this is a good time to purchase livestock risk protection for producers with cattle. With this market reaching to the level that it has right now, I think that the LRP policy makes a lot of sense. If you're not familiar with LRP, it's basically a government subsidized put option that you buy through your crop insurance agent. And so I think it's a great program for folks that are looking at a way to put a floor under the cattle market while keeping the upside open. So switching over to the grains, so we talked about all the masters of the air markets. Now we'll look at some of the other markets. Unfortunately, soybeans, we did have the USDA report out on Friday. These were their South American production numbers, and as usual, USDA's on the high end. They've got the Brazilian bean crop still at 155 million metric tons. That's still higher than the trade expected. That's higher than just about every analyst number out there. Again, maybe you don't focus a whole lot on USDA's numbers for South America. But that's what I kind of learned from all of this, because they tend to be a little late to the game and making some changes. But you can kind of see their numbers. They're still estimating Argentina at 50 million tons. In corn, they didn't change Brazil. They left them at 124. Most of the trade has backed that number down. Argentina's crop, they've still got it 56 million metric tons. And if you look at their numbers, the second column from the right, these are USDA's numbers. This one I didn't update down to 155, I guess, but you can see that they're still showing a record combined crop between those two countries. And the numbers on the far right column, those are some alternate numbers that I put in. And I said, what if the Brazilian crop dropped to 140 million tons? What if the Argentine crop dropped to 48? I don't know that either of these is likely at this point, but if it did, you would still have a record combined crop between those two countries. And so it does appear that the two countries will have a record. If you throw in the other producing countries in South America, you would assume that we're probably going to have a record production in the Southern Hemisphere this year. So weather-wise, things haven't really changed a whole lot. The vegetative health map here, as of about a week ago, still continues to show the driest areas of South America remain in worse shape than last year. The wettest areas remain much better. This has not really changed throughout the whole growing season. So this is the reason that Argentina's crop's going to be back double last year, whereas Mato Grosso and some of the surrounding areas are going to be down from a year ago. But over the last 90 days, they've caught some pretty good rains up here into central Brazil. This is Mato Grosso right here with some of the pink and even the white in it. So they've gotten some very beneficial rains, and it really put a bottom under this crop. Early on, there were some people trying to talk the Brazilian crop down below 100 million tons, thinking it was going to be a disastrous drought. And that really kind of stopped come mid-December. When the rain started coming. And so they've gotten enough rain to at least produce a crop. Now, if you look at the next 30 days, you see some haves and have-nots on here. And this week's forecast looks the same way. If you look at this week, it looks like Brazil's going to be fairly dry. Argentina's going to be fairly wet. A couple of things out of this. It ought to speed up the Brazilian bean harvest initially. So you should see a lot of beans hit the market a little bit quicker than what normally might be. They're just about done planting second crop corn in most of Brazil. So that corn's going in the ground right now, and it's going to be in need of some rain. And so maybe the market starts to pay a little bit of attention to that. It certainly doesn't seem to be the case here this morning. So we'll see as we go forward. But I would certainly think that there's some risk in that Brazilian corn crop. Of which about 75% of the corn they grow is double crop, and it's going in the ground or has just gone in the ground. So this is going to be kind of critical for it. It's kind of like almost moving into mid-September down in Argentina right now, and Argentina's crop pattern similar to ours in the central United States. So they're going to be wanting to start harvest here shortly. If they're fairly wet, might slow things down a little bit. And so there's some things to watch weather-wise here, certainly as we go forward. But if you look at USDA stocks to usage numbers at the world level, world ending stocks of beans even though they did drop their numbers slightly in February's report, it's still projected to be a record this year. Stocks to usage will be up for the second straight year as well. And so nothing real friendly here in this report that came out Friday. US's numbers in that report did not change. They left everything unchanged. But if you go back to January and February, back in January, USDA raised the final production number, 30 million bushels. Back in February, they raised lowered the export number, 35 million bushels. So Jan-Feb, they added 65 million bushels to the ending stock number and took what had been a fairly snug stock number and made it much bigger. So again, we're looking at a bigger U.S. stock number. We're looking at a big South American production. Consequently, we know what's happened to the soybean market, and we know what the funds have done. And as of last Friday, they're now short a record, almost 172,000 contracts of soybeans. So where do they go from here? That's the question mark. They're even shorter than when we had a record U.S. carryout back in 2019. So where do we go from here? Again, if you're a pessimist, you'd say, are they going to continue to lay on this market? If you're an optimist, you'd look at this and say they got a long way to go if they decide to go back to zero. Why would they continue to be short this market? I think that the obvious is that South America is harvesting a 7+ billion bushel soybean crop right now. It's kind of like the middle of harvest at the moment. And so, it's kind of like in the United States in the fall, that we're getting harvest pressure. Certainly the South American farmer is going to be selling a lot of beans right now. They're not going to have space for the bean crop at the end of harvest, especially. So we would anticipate beans continue to hit the market. So here's what's happened to the futures market. We did go down to make a new low in May beans. Fortunately, we did see some short covering. And, what's kind of odd about this is the timing. So funds have actually bought back, had bought back a little bit, but net, they're still shorter than they were. So it looks like maybe some of the buying has been commercial related, that, we've rallied 50 cents off the low to the current market this morning. Some of the buying was late week that didn't show up from the funds in that position report, because that report was as of Tuesday night. So we did see a little buying at the end of the week here that was responsible for a couple of these days of pushing the market higher. What do you do with beans right now? I think you do reward the market. We did get back above the 20-day moving average at 1164, which I thought was a big positive. And here on Friday, it did trigger some more buying. But we haven't really been able to even get back up to the 50-day, which is at 1207. And to me, that was one of the first targets that I would have had, maybe up around that $12 mark. If you get there, good time to liquidate beans. If you want to re-own them on paper, not a bad strategy, buying out of the money call. The next upside target would have potentially been the 100-day moving average at 1282. This chart gap just above $13, or right, it was just under $13. I'm sorry. So those would be some, no, I'm sorry, it was above 13 in the May contract. So those would have been some upside targets. I don't know that we've got enough weather left in the growing season in South America to get us to run to those levels. So I do think that this 50-day around $12 might be what holds this market as we go forward. Looking ahead to new crop, everybody's expecting more acres of beans this year. USDA put out in its baseline numbers back in February, 87.5 million still. That's up almost 4 million. I'm not that aggressive. I'm thinking we're going to be closer to 2 million acre increase. Here at the end of this month, March 28th, on a Thursday is when USDA will put out its planting intentions report. And so we'll get their updated numbers that are actually based on farmer surveys. I subscribe to Pro Farmer. They're taking a survey right now as well. They're asking farmers to submit their numbers. And so I think they'll be putting their numbers out ahead of USDA here at the end of the month. So it'll be kind of interesting to see what the numbers look like. If you use USDA's number with their trend line yield, they would come up with a record crop this year at 4.5 billion bushels of beans. They're optimistic that demand is going to grow, but they're looking at ending stocks being over 400 million bushels. I'm not using as big of a yield, gives me a 4.35 crop. I think demand will grow a little bit too, but I would expect ending stocks to be close to unchanged, still be above 300 million bushels. But we're all expecting prices to fall this year. Why? Well, you throw a bigger U.S. stock number on with South America's crop, that's probably how you get a bigger ending stock number. And, beans are already down in the 11s right now. So, as far as a price down in the low 11s, we're kind of been there as a national average right now. But we've rallied 45 cents off the low, even as of this morning's a little bit lower trade. And you can see we've traded right to that 50-day moving average line. So not a bad place probably to trickle off a sale. If you look at the stochastics lines, they've quickly moved into overbought territory, at least a short-term stochastic has this morning. But the good news is the 20-day moving average are trading a little higher or trending higher. So even if the market sets back a little bit, I think you would find some support here. It's very, very early in the growing season. Seasonality would tell us that, maybe we see a little bump over the next 60 days or so. So I want to use that bump to be pricing some beans if we haven't. Maybe this 50 days a good place. I think the $12 mark, 12 and a quarter up here at that 100-day, if we get there, I'm leaning towards being at least 50% hedged at that level. And I also want to look at the insurance program as well. Maybe look at ECO as a way to utilize that as a put option. Margin protection as well. If you'd bought that back in the fall, that was at $12.95. It looks pretty good right now. 95% of that's at about $12.30. So I would consider it to be an in-the-money put option as of today. So I do think there's some things I want to get done if the market gives us the opportunity here in the coming days and weeks. Where's it going from here over the next 12 months? I tend to lean towards a lower market. If you just look at this stocks to use to farm price chart, again, I've been writing this winter about how this decade seems to be rhyming with the last one, and it seems to be right, the last couple of years where we've made highs. What happens after we have these big high price years? We tend to see demand drop and we tend to see acres increase. And so whether it's U.S. acres, South American acres, and for the next couple of years back in the last decade, we trended lower. And it takes a while to get the South Americans to quit increasing acres. And when you got beans in the teens, they're likely to continue to do so. So I'm thinking beans are trending lower. And if you look at USDA stocks to use number this year, they're projecting 9.9% stocks to usage. And, that would be close to 10%. And the last time we were there, you had prices down under $10. So I don't think that's going to happen yet, but I would think we would be by fall be looking at some lower bean prices. The corn market, again, if you look at the balance sheet, USDA didn't change anything in this month's report, but the two numbers that really stand out to me from the last few reports, number one was last year's export number, dropping more than 1 billion bushels off the high the two previous years. And then we increased acres, 6.4 million this last year. And that was a bad deal for us. Couple that with a big crop, big record yield, and we've seen ending stocks now close to 2.2 billion bushels. So we've completely reversed the trend of tight ending stocks. Now we're looking at this huge stock situation. How do you get out of that? You either need a big drop in acres, feed demand, it's going to increase slightly in the year ahead, I think, but we're not going to increase the cattle and the hog numbers that quickly. ethanol demand, I think, is pretty well topped out. So you're really looking at exports. Can you get that export number built back up? A lot of that's going to depend on other buyers other than Mexico and Japan, et cetera. You're going to need the Chinese or somebody else to come in and buy extra corn. And otherwise, you're looking at, continued big stocks in the year ahead. USDA did drop its price a nickel to 475. Not a big change in last week's report. Now, the bright spot has been Mexico. And I live in Western Illinois. We've got a big rail shipper next door that ships a lot of grain that direction. And so you can see that shipments to Mexico have been running at a record pace this year, both accumulated and our monthly numbers. And so that's a positive, certainly. And that's part of the reason of this 2.1 billion number that USDA is projecting, being up about 400 plus million from last year. So that's been the one bright spot, certainly in corn. We're still missing the Chinese. And if you look at world stocks to use numbers, stocks are going to grow this year. Again, we're going to be the highest we've been, it looks like, since 2019. The stocks to usage number in the line here continues to grow as well at the world level. Most of that because of the growth in United States numbers. And so if you look at what the funds have done in corn, the red line really shows a year ago at this time. And that's when, they recognized that corn ending stock number, the export number was going to be continued to be low. Our weekly numbers a year ago at this time were really pathetic. And so I think they recognize that, plus the fact that acres were going to increase this past year, and they liquidated their entire long position that they'd held since the fall of 2020. And so when that happened, of course, the market started trending lower. You can see what's happened since then. Now, the positive is the last 2 weeks, the funds have actually not sold corn. And so they've actually built back or bought back some of their from where they had been a record short here just 2 weeks ago. And so I think that's at least something to build on here. I think that there's always going to be some uncertainty this time of the year as you go into the growing season. And I think that some of these traders probably figured that it was time to cash in and cover some of their shorts. And you can see that, from $1.08 drop we had from fall, we've rallied now about 27 cents even after this morning's lower open. So the positive here, can we stay above the 9 and the 20-day moving average lines? The indicators have turned positive very quickly. In fact, the short-term stochastic at 87 was really indicating very overbought here short-term. And so maybe this morning's little setback was not a bad thing for us. As long as we can hold above that 430, 431 area, maybe gives us a chance to trend higher. I would look again at the 50-day, the 100-day. Those would be a couple of targets. If you've got old crop corn to sell, probably every dime or so in here, probably not a bad place to liquidate some corn. About a week and a half ago, I recorded a thinking cap video on marketing in a weak market. And one of the things I talked about in here was selling corn and buying calls, or selling corn and doing a vertical call spread, because I did think that the market was very oversold. I do think you've got some potential upside for this market here as we go into spring. I think that this is a decent strategy for guys that just need to move corn, but are concerned or at least want to have the opportunity to make money if this market trends higher. And so back then, one of the things I looked at in that report was these short-dated options on December corn, because I do think that the December contract, if anything's going to trend higher, that December contract probably has the most reason to. We know what we've got in the old crop, but we don't know what next year's going to look like. And so maybe the December contract makes sense, but I don't want to buy that much time value to go all the way out to December options. And so you can shorten that up by looking at, and you can kind of see across the top here, you can buy other ending months, in other words, on December futures. So it still follows December futures, but the September one will expire in late August. The August one expires in late July, et cetera. So those might be some ways to utilize the December futures contract, but buy a shorter time window. This morning, I ran these just on the September option. So September futures, if a person needed to sell corn, you could go out and buy a September call for 18 cents today. Or I could look at some kind of a call spread. And I like the idea of, say, for example, buying a 480 call for 25 cents, sell a 520 call for 15 cents. It gives me a 40-cent potential window. It costs me a dime. So for people that don't want to spend as much money, but you want to have some upside potential, that might be the type of strategy you consider. And so if corn goes above 520, then both options are making money penny for penny, and you stop earning essentially money. But you could make technically up to 40 cents and it costs you a dime to do it. Something like that might be a good strategy for folks that have old crop corn to sell. You want to get the bins emptied, but you also still want to stay in the market. Looking ahead to new crop, I think that the long-term trend right now is still down in corn. USDA was using 91 million acres. I'm using 92. I don't think we're going to cut as many acres as what they do. I think that you likely would return to a normal prevented plant type year. Last year, we had one of the lowest we've had in record. I would tend to think that you'd pick up a few more prevented plant acres this spring. We'll see. Right now, the Midwest doesn't look like it because it's pretty dry, but we'll see what happens. They're using a trend yield at 181. I'm using 178. Both would give you a crop right around 15 billion bushels of corn. Both, I agree with them that demand should improve, but we're both thinking over 2.5 billion bushels of corn, which would likely mean, a growth in stocks to usage and a lower farm price this coming year. And so with where we're sitting today, we've rallied 20 plus cents off the low. The indicators have turned positive, although this morning you see a little bit of a setback. A few things I do want to point out on this chart. We've got our crop insurance price at 466, which we're basically sitting right back on it here this morning. I put the March corn low on here, which to me would indicate where the potential, if we end up in a lower trade, say this fall, where would the market try to go? And I think as you look at like the weekly charts, especially, or even looking at the nearby futures charts, that might be a magnet for this market if we have a good crop and the market tries to trade lower this fall. So to me, that points out what the risk is in the corn market. So if you had margin protection coverage at 509, 80 or 95% of that's a little over 480, looks like a pretty good in the money option at the moment. B, utilizing ECO right now at 466 times 90 or 95% might also be a good plan if you're concerned about lower price in the next several months. And then C, looking at put some offers in on these bounces. The 50-day moving average, just a few pennies above us at 474, might not be a bad place to trickle off a little sale. I think I'd get even more aggressive up around the purple line at 493. That's the 100-day moving average. There was a little gap at 502 that was left back at the beginning of the year, and that happens to be just under the 200-day moving average at 504. So I think there's some natural places here I'd want to have offers working. Again, I'm looking at being trying to push myself to 50% sold if we get back up to some of these targets, especially that 100-day moving average line. And so couple that with utilizing crop insurance like margin protection or ECO, kind of like a put option. I think that is a way you can at least build a program that's going to protect you if this market decides to go back down. And certainly the balance sheet numbers penciling in 91, 92 million acres would indicate that. The one glimmer of hope, Arlen Suderman, I think, put this out the other day on social media, but was pointing out that the seasonal, and I've been comparing, I'll go to there first and then come back. But if you look at this, again, how this decade seems to be rhyming with the last one, when we trended lower for 2+ years following the blow-off high of 2012. And we're kind of in that same mode right now. But USDA is talking about stocks to usage being up over 17% this coming year, potentially. Now, that might be a little aggressive, but anything over 15% would still, I think, be bearish this corn market. And so if you think there's a chance that we're going back below $4 potentially, or at least you want to protect yourself against that, we've got the tools to do it here. And I think that this is that window that we want to be looking at over the next 60 days or so. Going into the planting season, if this market gives us a little bounce, be a great opportunity to be locking some corn in for this year. Wheat, USDA made one change to wheat, and that was lowering exports, 15 million bushels, which was bearish to the wheat market, took ending stocks up again. They did lower the farm price. You look at the stocks to usage numbers at the world level, though, and I think this excludes China, but you're still looking at a somewhat tightening situation at the world level. But U.S. numbers continue to be bearish. And if you look at USDA's baseline numbers, they're expecting growth this year. We're expecting a bounce back in the hard red winter wheat crop this year. I would expect to see more spring wheat acres of wheat planted as well this year. If you look at the fund position in wheat right now, they're holding short around 60,000 contracts of Chicago wheat. They bought back a bunch of their short position back in December when China bought wheat. Well, what's happened over the last 3 days? China's been canceling U.S. wheat. And so now you've seen the funds selling back into this market once again. And if you look at Chicago wheat, it's made a new low here in the last couple of days and trading lower again here this morning. The crop insurance price was set last fall at $6.61. Looks like a pretty good deal right now as a put option again on price if this market continues to trend lower. The one thing I would point out, I wasn't going to talk about government program election this month. I think we beat that over the head pretty hard over the last several months. That said, the PLC program on wheat coupled with SCO coverage still looks like the best program on wheat. And so the PLC reference price on wheat is $5.50, and the market's trading $5.40 right now. So wheat might be one of the crops that you would look at potentially to trigger PLC payments this year. And so I wanted to point that out, that we're already below that. I've had that conversation with several people in the last few days of which program and wheat and why PLC. Well, this is the reason right here. You look at Kansas City wheat right now, funds continue to hold a short position, short about 40,000 contracts of wheat. That's the biggest short position they've held at this time of the year. And you can see where the market's at. We did get a little bounce at the end of the week. RSI and stochastics had moved back out of the not zone, but they're still not very strong at the moment. And so can we hold the 9 and the 20-day moving average here over the next several days? Maybe you push back up to the 50-day, the 100-day, give us an opportunity to make some hedges. Looking at spring wheat, again, the funds short record amount for this date, about 24,000 contracts as of Friday's report. And if you look at that market, again, it's rallied a little bit off the lows. Can we hold the 9-day, the 20-day moving average over the next several days and continue to push higher? And if we get back to that 50-day moving average at $7, I certainly want to be a hedger. Anybody that bought margin protection insurance at 805, that looks like a pretty good deal as of today. Finally, cotton, and I didn't mention this in wheat, but I did back at the beginning, but one of the big factors I think that's been bearish wheat has been the opening up of the Ukraine. And I know their production is down, but Russia had a record crop this past year. Ukraine has been able to ship their crop, and we just haven't had that bullish trigger in this wheat market for several months now. Going back to December when China bought U.S. wheat, that was really it. But now that they've been canceling over the last 3 days, it's really turned this market back to negative again. Finally, cotton. And somebody posted this on social media at the end of the week. I thought it was pretty funny that cotton is the one market right now that's kind of feeling itself, I guess you'd say. So maybe cotton buys some acres with the rally that it's had. And if you look at the balance sheet in cotton, it's been the opposite of what we've seen in the other markets, where USDA, again, this month lowered the yield, took production down, lowered ending stocks, another 300,000 bales to 2.5 million bales. So the U.S. balance sheet is pretty darn tight right now, all things considered, and that's what's given us a rally in this market. The world numbers, usage has improved a little bit. That's what's taken the stocks to usage number down slightly at the world level. And so again, that's a positive. Funds, unlike corn, beans, wheat, they're holding a record long position at this point nearby cotton. And so we'll see how long they want to hold it. But I think that the market right now is recognizing that cotton is the one crop that we could afford to move acres, and it's trying to do the job to get that done. And we've taken May cotton up over $1 here in the last several sessions. And you can see the indicators, the RSI had moved up to 80. This market was very overbought for several days. Stochastics as well. We did back off a little bit last week, found some support at the 20-day moving average. Here this morning, sitting back right at the 9-day again. And if you trade above it, I think, the indicators are positive at the moment. And I think that, again, this market's doing its work to try to induce some more planted acres this year. And Susan Stroud put this chart out in her letter, showing how cotton is trended versus corn and beans. And I had put on Twitter or X here the other day, hashtag plant more cotton, because that's what the market's trying to tell us to do. How much more acreage will we move to cotton? Well, USDA, I'm in agreement with them. I'm using only 11 million acres. And I think you could, the incentive is certainly there to try to swing more acres to cotton. The question is, will it get done? I don't know about the Texas ground. If you're going to be able to pull acres away from sorghum or feed grains to move into cotton, I do think that the Delta is where you're probably ripe in the Southeast. Can you swing some bean acres and some corn acres to cotton? I think that that's the area of focus. And even though it's not the biggest area anymore, certainly that's the area. You get down in Louisiana, some of these states. I think that that's the area where we need to see it happen. Secondly, what's the yield going to look like this year? But even if I forecast a higher yield with higher acres, you're not seeing a huge increase in stocks, 3.2, 3.3 million bales. And so I think this cotton market does have some legs. We've been talking about that for a long time. Really wasn't an incentive to hedge any cotton under 80 cents. Now, as you get up into the low to mid 80s, might be some incentive to do that. Look at the RSI and the stochastics. You go back to these highs at 85 cents. The market was screaming overbought and was ready for a correction. It did, but now the market seems to be trying to find its footing again. And so you get back up to 85, I'd probably hedge a little, probably be looking at that put strategy again. Maybe you buy a put, sell an out of the money put, or buy a put, sell a call, take an upside ceiling in order to put a floor under the market. That's strategy I've liked in cotton over the last several years, the min-max. I still think it's not a bad strategy this year. I didn't talk about it in corn, but I still think it's a good strategy in corn this year, where if the market rallies, now in addition to some sales, maybe I buy puts and sell out of the money calls. I'm not too concerned about corn going to $6 this year. It would take something very drastic to make that happen. So I'm willing to take a ceiling above the market, sell a call, maybe to help me raise my floor on the put option that I buy. Finally, switching over to weather. It's that time of year where we're starting to look at weather, and I think the market will do so as we go through the month of March. And I've been in Iowa and southern Minnesota and Nebraska over the last month or so, and a lot of focus out there, a lot of talk about the extreme dry weather. And this was it's an experimental map, but it kind of shows the, different drought monitors, et cetera, put together, and shows you what's kind of happening. And the Midwest is certainly the area of focus as we go into spring this year. How dry is it? Can we alleviate these dry conditions ahead of planting season this year? And the other focus has been on the development of La Nina. That the El Nino is going to disappear sometime this year. La Nina is going to surface. The question is timing of this. And the earlier that La Nina would show up, probably the worse weather we tend to see for the West and moving into the Midwest. And what we're already seeing is the cooling of the surface temperatures at the equator. And when that happens, that forwards the development of La Nina. And so if you look at the forecast, the latest forecast issued in February, we'll get another one out here in about a week. But you can see the forecast is for El Nino in red to continue to subside as we go into spring and summer, and the development of La Nina. And so that development of La Nina tends to bring with it warmer, drier conditions, especially into the central part of the United States. How fast does it develop? That's the question. And will it have a major impact on U.S. weather? Now, I think just about everybody's in agreement that it's going to happen. We've got the Euro model forecast at the top and the U.S. weather model down at the bottom. And these are June, July, August precip maps on the left and July, August, September precip models on the right. If you look at the US model down at the bottom, it shows drier conditions moving into the central part of the country and sliding into the Corn Belt throughout the summer months. If you look at the European model at the top, it shows, I guess, a later development of La Nina. And in fact, they're even showing above normal precip through most of the Corn Belt throughout the summer months. So we've got an extremely different set of models here. The question is, which one do you follow, and which one's going to happen? Is either one of them right? And nobody knows at this point, but that's what's going to make a market here over the next several months. Now, I think everybody's in agreement that it's going to be a hot summer. It does get hot every summer. I don't think anybody disagrees with that, but we're looking at above normal temperatures throughout going all the way out into fall. So, except for the next couple of weeks, I think it's supposed to be cooler. So, the precip maps are going to be important. We'll be looking at and listening to a lot of folks. I've subscribed to Empire Weather. Eric Snodgrass with Nutrien puts his stuff out every day. So there's a lot of good sources to weather information, and that's going to make a market, and at some point might give us an opportunity to be able to make some sales here for this year. The other things I want to look at, supplemental coverage option and enhanced coverage option, SCO and ECO. I still like these programs this year to be able to add extra coverage at the top end. And I look at ECO, enhanced coverage option, as a put option. Right now, it's going to also provide bushel protection. But this past year, we looked at ECO as a put option, and it worked. Market went down, and that 95% trigger was able to provide some of that extra protection. And that was a thinking cap video. You can go out to YouTube and listen to it. My thoughts on using ECO this year. But this shows how these coverages all work together. I've got my individual protection up to as high as 85% in blue. The next band that we have above that is either SCO or the ARC program. Remember that the government won't let you sign up for ARC if you add SCO, because they're both very similar. These are both 86% triggers, both based on your county. This year, the ARC prices for corn and soybeans in particular have gone up a lot, where the crop insurance price for SCO has gone down. And that's why, especially on corn, we're favoring the ARC program. Unless you have a farm that doesn't have any base acres of corn, in which case ARC doesn't do you much good. So there are those out there as well. Those you might want to look at SCO if you want to protect this middle band. But I'm primarily looking at the ECO bands at the top, the 86 to 90 or 86 to 95, as a put option. And we don't know what's going to happen with yield, but we do know where price is. And if I'm fearful, for example, that corn could go to $4 this fall, ECO at 90 or 95% might be able to give me some downside price protection. Now, this was an example of our producer profitability matrix that I showed a year ago, but we showed how utilizing these products when we had 591 corn made a lot of sense. And we can put in expenses over here, your expenses, whatever you want to put in, forward sales in the green, but we can add SCO and ECO coverage. And a year ago, if a producer just bought 80% RP coverage, didn't do anything else, it shows where you were susceptible. This downside price was where we stood the opportunity to potentially lose money, even if we had a good crop. And so corn did go to 488 at the harvest price. And if a producer was expecting to grow 200 bushel corn, he went from a gain to a loss situation. And so utilizing SCO and ECO along with forward selling last year, put us in a pretty good situation, even when the markets went down. And so this year, what can we do? Well, here's where the crop insurance prices have been trending over the last, several years. And I've continued to point out that we seem to be rhyming a lot with what happened in the last decade. And in 2013, we went from 565 to 439. And in 2023, we went from 591 to 488 in the fall. The following year, we started 2014 at 462 on corn. This year, we're starting at 466. That year, we went to 349. I'm not that pessimistic, but the balance sheet numbers are actually we're looking at for this coming year could potentially be worse than they were in 2014. So I do think the risk is there of the market going lower this fall. Same with beans. You know, we're in that same type of a window that we were back following 2012. And so I don't think the same program works as last year. I don't want to be forward sold at today's price like I was a year ago. B, I might look at ARC instead of SCO to save a little bit of money there on my crop insurance. But I do like the ECO program. And this is an example of a calculator we've got. But if we start out with a 466 base price on corn and the harvest price were to end up at $4, this is an example that I had run recently in Nebraska. But just looking at that 9% ECO band, that value of that band, first of all, we figure out the value, and that's worth about $94 an acre at 100% of the dollars. If I buy that maximum dollars, it's worth $94. If the yield doesn't change this fall, but the price goes from $4.66 to $4, I've lost essentially 14% of my revenue, which means I'm going to max out that 9% band of ECO coverage at $94 an acre. Now, this past year, a lot of people did this, but also a lot of folks didn't want to spend the money on the premium. So if you still want to have the 95% trigger, but you're not sure that you want to spend as much money, you can buy this dollar figure, this 94, down to as low as 50% or anywhere in between. So for example, if I were to buy this at 50%, that changes my dollars of protection to 50% of that number. It also cuts my premium 50%. So I save half the money. I still have a 95% trigger, but I'm only essentially getting paid 50 cents for every dollar lost in the county. So if the county lost that entire band, I get paid $47 instead of 94, but I paid half the premium. So I think that this might make sense for a producer that thinks that there's a chance of this happening, and maybe you've got a bunch of corn already sold, or maybe you intend to sell 50% of your crop. And so I would look at this as an example of maybe instead of looking at it as 50% of the dollars, look at it as 50% of my acres or 50% of my bushels, however you want to look at it. But if I want to utilize ECO to protect 50%, I can still do that and cut some of my insurance premium in half. So I did want to bring that up and show you because it is a possibility. A lot of people aren't aware. But if you've got a bunch of corn sold already, but you still want some protection at 95%, this is a way to do it. So my thoughts on especially corn bean markets this year, work my offers, above the market now. The next 60 days, I think is going to give us our opportunities to be able to get some hedges off. We want to have those offers in the market. Probably on corn, maybe on beans. I know a lot of folks on beans are still utilizing SCO because the price is higher, but especially on corn, maybe you sign up for the ARC program, save a few dollars there, and then consider ECO as a put option and on anywhere from 50 to 100% of my acres, because I do think that that's given us, at that 466 price times 95%, it is giving us some extra protection that we can still get bought between now and Friday. So now's the time to look at this band. How are we going to be able to protect our bands of coverage? NAU Country also has a product called Easy Rev. Easy Rev is a product that basically allows you to add other months to your insurance base prices. And so if you think that there's that good chance of that May, June, July window, again, maybe giving us a better pricing opportunity, this would allow you to do it. Here's an example of our quoter. This is an example for Jackson County, Minnesota at an 80% RP policy. If I were to check the box to add the months of May, June, and July, if any of those months would have a higher average than for example, 466 on corn, then you get to utilize that price. As of Friday, this would have cost me about $6.50 an acre to be able to have those 3 months in addition to that February price. This is only on your RP policy. It's not on SCO or ECO. So it's just on that 80% coverage level. But you can see how the quote looks. And again, this is adding May, June, and July. And this shows the history of adding the May, June, and July windows. 73% of the years that's been above the base price. Doesn't necessarily mean it would have triggered a payment, because you would, we do have your yields come into play as well. And so sometimes, even though the price was up, maybe there wasn't a big enough bushel loss to trigger a loss, but it does increase your revenue coverage in that case. And so if you're looking to potentially improve that, this is one way to do it. Also, NAU has a couple of other products called BPM and Price PM Plus. These are products that basically allow you to add extra dollars to a loss situation. If you were to lose bushels, then you could end up getting paid more money. And so I invite you to check those out as well. But coming up, we've got CONAB, the Brazilian government, with its crop report early tomorrow morning. I would bet the farm that they will have a lower number than what USDA did on beans. Just a question of how much lower will Brazil government cut their number. The 15th, this Friday, is our deadline for crop insurance decisions. Also the deadline at the FSA office. March 28th is our planting intentions report from USDA. So about 2 weeks from now, that'll be kind of a big one. We'll be able to take their updated numbers and plug them into the balance sheets, see what we think could happen for this year. The markets will be closed on Friday for Good Friday. Markets will reopen on Monday. Then on the 11th, we'll get USDA's next WASDE report, and we'll also talk about it on the 12th. So hopefully by then, a lot of people will be in the field, but we'll always record these, and you can listen to them at any time. So I don't see any questions coming across, so we appreciate your time and attention this month, and we'll get export inspections numbers here in a few minutes at 10 o'clock this morning. We'll continue to watch those numbers pretty closely. This week, the Federal Reserve will make comments. I doubt they'll make any changes to interest rates, but we'll hear what they have to say. This Friday is the deadline for crop insurance and at the FSA office. So hope you have a great rest of your month, and we'll talk to you again very, very soon. Thanks for joining us.